Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 9th, 2025. It is 10:44 a.m., just turned Eastern Time, and here's what we're going to cover in this video. I'm going to start out, as I often do, with the equity markets, quick overview there, and then want to talk about kind of the core things that I've been focusing on lately in addition to the equity markets, and that's the credit markets. I'm going to talk a little bit about junk bonds, seeing some movement there, some significant technical developments, let's say. That's more accurate. Treasury bonds, private credit, and then I definitely want to do an update on the metals and miners as well, seeing some things there that stand out. So we'll go through it in roughly that order. Time permitting, any other, kind of one-offish trade ideas, individual stocks, sectors, whatever. All right, so there's QQQ right on the line. Just needs that little nudge. This is the primary uptrend line. Here, I'm looking at it and let me highlight it for you. It comes off the key April lows right there, and that's it. So we're waiting for a solid break, meaning solid, get down here, enough intraday that it's unlikely to see a whipsaw. And again, as I often say, you can take those breakdowns on face value. You jump on it on the 60-minute chart. That's going to get you in earlier. This is the what I call my BOD trend line here, benefit of the doubt, because it's the lower of the two. It catches all the reactions off this September low. Remember, this is a 60-minute chart, so that's going to get you in a little faster. I put good odds. This is, this is just a ripe wedge, what I call ripe for a breakdown. It's just the sweet spot of the wedge, about 70-80% towards the apex of the wedge. This is usually where wedges break down. So, I told you I really like the VIX right now. I love the RR profile on the VIX. QQQ, small caps, and I'll show you why, the smallies too. I haven't updated those in a few days, but we have an active short trade on the small cap, so I'm going to get to that too. Let me actually write that on my pad here, so I keep forgetting to cover IWM. Let's just jump over to it. Let's do that. IWM, small cap ETF. This is a daily chart right here. So this is the primary uptrend line, also off the April lows. These are just key uptrend lines. I can guarantee you just about every trader that uses technical analysis, professional or retail, are watching these trend lines. And we already had a sell signal, was right here. And as I've covered, we've been back testing the primary trend line now for going on, about a week and a half there. Rejection candle there. And then I've set up, you can see this kind of a call to BOD or an alternative minor trend line, really. And that's the one you can see on the 60-minute chart I just started with. So once that goes, you'll have a clear rejection. I always say the problem with shorting, when you're back testing a trend line, is you can continue to back test for a while and you're going underwater. Same thing when going long on a breakout of a downtrend line. Sometimes you back test. So once you get that clear rejection and you start walking away, you're no longer hugging the trend line. That's usually when it's done, and then the move starts and starts to build some momentum. So 60-minute chart, that's the that alternative trend line right there. As you can see, it's nice and well defined. So either way, we're at or above support on QQQ, as I just showed you. IWM. SPY broke down. The best trend line I have is on the 60-minute charts, this little one, and I already covered this. We broke down recently, back tested, and need to take out this level right here, about 667 and change. And that should get the party started. This little today's marginal new high is still a divergent high, so nothing's changed in the technical posture or outlook. And yes, it continues to be one of the most resilient trends in years, with most of the dips getting bought up pretty aggressively. And again, like I said, to me, it's very simple stuff. It either works out or it doesn't. No sell signals 100%. There's not anything 100% trading, but this is the one I've been waiting for right here. We need to see that clearly get taken out, and then I think you'll see the selling start to kick in, and things should go the other way. So remember, other than the relentless bid and the AI circle jerk going on right now with money going into and out, round and round there, and that's kind of fueling the big AI related stocks, anything tech related, which also reminds me of XLK. Remember, we're also waiting to see XLK go, the tech sector ETF. I wanted to touch on Treasury bonds real quick. And like I said, Treasuries, since the Fed rate cut, rates went up. And they're just kind of holding right here. They're not really going up much or down much. You can see this is TLT, the 30-year bond Treasury ETF, about flat, hovering above that key support level. And what I'm noticing there, and let me look at the 10-year for you as well. The 10-year certainly matters. 10 years down, meaning yields are up a little today, but nothing much. But what stands out to me, and this is something that I've told you I've been watching and waiting for a long time, and I think we're there. And I think it has a lot to do. I try to connect the dots. I try to look for things other people aren't seeing in the market. When you have a bulletproof rally, it's going to take a silver bullet to kill it. And one of those things I've been warning of and actually predicting is just a problem in the credit markets. And again, I've showed you on BIZD, the private credit companies have been, a lot of those, I won't use the word imploding. Some have been imploding. I just covered that yesterday, GECC. It's a little relief rally today. But like I said, that's likely to spill over. If they're having problems there, and we're seeing, we had a big Chapter 11, one of the huge automakers that makes just about, I read up on that one. It said if you've had any work done, on a used car in the last, anytime, the last decade, there's about 100% chance you had the parts from that company, than what I mentioned yesterday, that failed and blew up that one private equity company that had money out to it. And before that, it was Tricolor, the big auto dealership. And so we're seeing those are little fissures, if you want to call them fissures, maybe cracks. And again, until credit spreads start to widen, that's going to be supportive. These very, very low spreads have been supportive of this rally. And so what you're seeing today, you're starting to see some movement here. Both, again, one day, and this isn't much. This is JNK, the junk bond ETF, one of the two that I follow, down 1/3%. That's not a lot. But again, fixed income, guys, that doesn't go up and down much in percentage terms. So you could just eyeball these candles and see this is, at least the last few days, on the bigger side of a move. Again, nothing outright alarming at this point. However, it is technically significant. That's what I wanted to talk about, because you've heard me say this often. Sometimes I can see the stock market or an individual stock go up 3% in a day, or an individual stock 3, 4, 5, 6, and it may have a very, very big technical significance. If, for example, if it's a breakout of a bullish chart pattern, that big move is what you want to see, a high impulsive move on above average volume. That's technically significant. What isn't is just a random move that doesn't change anything in the technicals. That is a breakdown. There's the trend line I've been watching. So if that breakdown sticks, which again, that's as much as anything, something to monitor. Even if you don't care to trade junk bonds, you want to monitor this. And what you want to look for are junk bonds falling more relative to Treasury bonds. And again, you can check credit spreads. Just Google that. There's plenty of charts out there. And look at the credit spreads, which are the difference or differential between what safe haven Treasuries pay and what higher yielding, higher risk junk bonds are paying. And again, they've been sandwiched down near historical lows. In my opinion, it's one of the most likely what I call, gray swans for the markets, because it's something that I'm not the only one that's aware of this and those conditions. In other words, the market and the credit markets are priced for perfection. They're priced for zero, for no recession risk, no blowups in any of the credit sector. And we know the markets, the credit markets, everything, individuals, consumers, and businesses are very heavily leveraged right now. I've showed you the FINRA margin interest at all-time highs and surging, and that everyone's using margin to buy more NVIDIA and keeping that. Again, it's a vicious cycle, and it's going one way right now, which is driving the market up. When that trend reverses, it can be very powerful. So again, just watch This isn't end of the world stuff. We're only down 1/3%. The other big one is HYG. If you're tracking the junk bond ETFs, that's also down about 1/3%, but also clearly below the trend line. So it just broke down, and that follows, a divergent high. And there's a chart, and so if you see junk bonds continue to fall, especially fall more than Treasury bonds, that is widening credit spreads, and then you'll see the sooner than later. Just like I talk about the U.S. dollar. Let's roll into that next, and then we'll get to the dollar, and let's do that now, and then we'll get to GDX. Like I said, it's a incremental thing, but it's also, for lack of a better word, exponential. In other words, as you start going up, again, gold bugs are focused on just the relentless trend in gold and silver and GDX, and they've been dismissive of this. The vast majority of analysts have been calling for a lower dollar for the reasons Fed's going to be cutting and all that, and the opposite, as I predicted, is happening. Since back here, we held support, long-term support, went up, hit my first target, and we're about there again. And as I've been saying for weeks, if not months now, this is where I believe that POR comes in. But again, it's point of recognition, where gold bugs realize that, hey, we have a rising dollar, and that is net bearish for gold. And let me repeat that. Net bearish doesn't mean if something's net bearish or a headwind for an asset, it doesn't mean it necessarily will take it down. It just means, for the reasons I've stated many times over, and we'll repeat, gold, at least the gold we're trading here, GLD, gold futures, they're priced in US dollars if you're trading it here. And when the dollar goes up, it takes fewer dollars to buy an ounce of gold, and therefore the price will go down if you freeze supply and demand. Or even if gold, there's a lot of demand, it's just going to, again, slow the ascent of gold down. Likewise, a falling dollar is very bullish for gold. And this was to a very large extent, the catalyst for gold. Now, there's fundamental reasons too. People worried about, okay, we see this, Biden administration was big spender. They didn't care about the budget. Trump's the same. They would have different things they want to spend money on, but they are both going to, just continue to swell the U.S. deficit, lead with deficit spending. And so that was all that. And you also had the fundamental reasons for going into gold and Bitcoin and other things with the debasement of the planned, intentional debasement of the dollar. But again, as I said, the dollar doesn't trade in a vacuum. So if the ECB and Japan, they want to start, bringing their currencies down too, and other factors come into play as well. Geopolitical or instability in the financial markets usually lead to a lot of money flocking to the dollar, and so other things can make it go up as well, guys. Just let's not get into the fundamentals too much. Just understand this is the level that, if popped, it's going to increase the odds that we're going to go up and hit my second target. And this, again, in my opinion, will be incrementally or progressively more bearish for gold, GDX, and silver if that happens. Now, it may not happen, or may happen, but it may happen 3, 6, 9 months from now. Who knows? So if we get this, again, that's going to be net bullish for gold and silver. And again, I'll repeat, that doesn't mean that they can't correct or go down. It's just, you have a falling dollar. It takes more dollars to buy 1 ounce of gold or 1 ounce of silver. It's that simple. So, all right, let's move on and watch that. Again, we've seen, since the Fed has cut rates, we had a little blip, and the dollar has gone nowhere but up, whereas a lot of folks expected the dollar would drop. So, and then to loop back to the private credit markets, BDC, business development companies, making those loans to, loans that don't have the reporting requirements. It's private credit, just like private equity. That's the difference. You have publicly traded companies, have to be very completely open on their books, have to report earnings on a quarterly basis. If they give you guidance and they're bullshitting you, and it wasn't, a complete miss, you could actually, face civil, or even criminal charges as a CEO, as a company reporting. So everything is very well regulated, and then you have the private credit and private equity markets, which isn't. Anything goes there. And so, as I said, they sat on that one company, GECC, sat on a loan that, again, I think it's criminal, or at least, not criminal, but gross negligence. If I worked for Great Elm Capital and I wasn't, and I had a loan that big outstanding to that auto part maker that just went belly up, that I didn't know what was going on, that I wasn't looking at their books and their financials. Again, they don't have to be a publicly traded company, but they still keep books. And so, again, this is just what happens. And often, not always, if there is a lot more of this out there, in other words, those mispriced loans that are overly inflated to their true intrinsic value right now, quite often things like this become a catalyst. So just continue to watch this sector. Maybe it'll be a one-off, and it's just there's been some nervousness and profit taking, but BIZD, this is a way to monitor the sector as a whole, continues to be in free fall, and almost to the extent. And again, this just doesn't mesh with the stock market at new highs. This is when everybody thought the world was coming to an end, just like COVID. This was when Trump stepped to the podium and announced those insane tariffs, and things. This sector was in free fall. This is in free fall now, yet the stock market's flirting with new all-time highs. That doesn't jive. All right. So again, if this all of a sudden recovers and it was just maybe an overreaction, a great buying opportunity, so be it. And then you'll know that, and you'll see this sector recovering. There's a downtrend line, and you'll say, wow, that was a good buying opportunity. Like I said, I'm not buying these. Somebody asked if they could the other day, and I gave you my thoughts. I said, no, I mean, you can do that if you want to, but this sector is showing problems. These companies are just blasting right through support. I'm going to put another level here. What I'm doing is I'm clicking on the holdings, as I often do when I'm doing these videos. I've got the list of the components right here, and I like to do this just to make sure it's systemic within the sector, not just one company. And it's not. You can see they're all falling, and some of them are at or even have exceeded those lows back in April, like this one right here. And so it just keeps blasting down through one support level after another. And this drop right here on this one, BXXL, and this is Blackstone. They're a secured lending fund. It's not Blackstone, the entire company. But it's dropped the same amount it dropped at the same rate of descent that it did right here. That's about the same. Started a little higher. Slope is almost equal. Okay, so I don't know. The stock market fiddles while Rome burns is what it looks like to me. So we'll see. These guys either come in here soon and start to rally, and it was all just a little overdone, and or not. And if it's or not, that means it spills over to the rest of the credit market. So that's why I'm watching very closely junk bonds. I'm watching, and we're short regional banks. Continue to watch those. If I go to the sector, there's some that are I've had price alerts, about 3 or 4 today fire off on regional banks like this one that are breaking support. This one had a symmetrical triangle starting to break down. It's not done yet. You have a little previous reaction low right there. It needs to take out. But you can see quite a few of these regional banks are starting to really, they're well off their highs, and they're breaking down. They're breaking 200-day moving averages or key supports. So again, it's both an active trade and a sector to watch if you don't care to short the regionals. Fifth Third, we already hit our first target, waiting for T1 to get taken out, and then that should take us down to T2 and T3. Here's a trade idea I found for you today. I was just I was cycling through the consumer discretionary sector. That's a sector you want to watch, when for signs of the economy slowing down or turning. Consumer discretionary, as the name implies, discretionary income is you buy things that you want, not things you need. Think about Ferraris, things like that, which, by the way, now that I say that, Ferrari taken on the chin today. This is RACE, RACE, which is Ferrari. It's been in this, multi or year long plus trading range. Now it's coming up on the bottom of it. I had a circle drawn there. Just that needs to be this is support right here. So it's coming up on support. If you like Ferrari, you buy it at 404 or just above it, with a stop somewhat below. But that's just big, big, big support. And again, it's technically, telegraphed in the charts, if you will. This was a big divergent high. And again, this is just kind of a tell on the economy and what's going on there. I don't know. It must have been, I imagine, an earnings-induced event. But again, big, big support. So watch this. Do you short it today? No, I don't. Not down 14% to support. If anything, you buy it here. But you also have an uptrend line, the primary bull market uptrend line on Ferrari. So these are the things I'm watching. I'm watching things that are, kind of signal what's going on in the economy. So if this one, and it ultimately will break, whether we bounce first or not, no uptrend, no bull market lasts forever. You're going to get corrections and bear markets sooner than later. But again, the consumer discretionary, if you look at XLY, it is the third largest sector in the S&P 500, and that's one I'm watching as well. And it's already, as I covered all the sectors with you recently. It's already broken down, so it's telegraphing that it's going a lot lower. Just put in a divergent high, double top high, failed where it failed back in late 2024 before this big drop. Had also a divergent high there and a sell signal with a breakdown of that wedge right there. Here we had a breakdown back test coming up on the 50-day moving average. Once we take that out, I really don't have any price support till down here at about 226.87. So we'll call that 227. And so a sector to continue to watch because it's going to tell what's happening in the real economy. Again, AI is its own thing. As I said, that vicious cycle or positive feedback loop will work until it unwinds, and then I think it's going to go the other way, and it's going to be one of the most profitable shorting ops in generations, along with the market and some other things there. But right now, watch XLY. If this continues to play out like this, go there, hit 227. They'll come in and buy it, most likely. That's pretty decent support. And then come down here to that 219.88. We'll call that 220 support, which comes in with the 200-day moving averages. And then if and when those get taken out, something's bigger going on. So that's just a correction right there that would take us back to, and that is my preferred target. I just showed you the path that I think it's going to take with a little bounce off 227, but that'd be about a 10% drop. Now, if XLY, the third largest sector in the S&P 500, goes down, I will almost assure you tech will have broken down, and that's going to give you a pretty more powerful sell signal on the market. Tech is by far the largest. But this is, again, guys, this is a tell on the economy. All the rate cuts in the world, and I can all but give you my word on this, all the rate cuts in the world aren't going to do anything if the job market has not only clearly rolled over, which I believe it has, but we start to see, as historically we always have, acceleration on layoffs and unemployment, and the turn is in. In other words, the trough, which is already in on the charts to me, we just need to start accelerating up. You have that. It is a vicious cycle that just can't be stopped. 70% of GDP comes from consumer spending, so the government can spend they want, stimulate. Again, that's a big if. I can't promise you that the job market's going to continue to roll over. If it does, but you want to watch this sector because those in the know, insiders, and the very, very smart money on Wall Street, the big hedge funds, they're going to be watching these companies. They're going to be watching Amazon. These are all your components here. Tesla. Tesla's broken down now from that. The day isn't over. It's had two intraday breaks of that ascending broadening wedge pattern I highlighted, but we're clearly below it now. So let's watch for a solid close below. There's a sell signal on Tesla. We're still below that bearish engulfing candle. These are, again, the components of XLY, the consumer discretionary sector ETF. There's Home Depot. Let's put a trend line right there, and price support, dual support. So I'm going to say this, and I mean it. If you are bullish and you're looking for a blue chip stock that's maybe doesn't have a lot of hot air in it, like Nvidia or any of those Here's the bluest of blue chips in the home improvement sector. Home Depot at triple support, not double. We have price, very, very good price support, by the way. Look at that. Reaction high, reaction low, reaction low, reaction low, support, support. Support once broken becomes resistance. There was broken there. We came back, got rejected. And look at those beautiful 200-day moving averages. So, like I said, triple resistance. The 200 simple and exponential moving averages, which tend to define bull and bear trends. They sell it when you're in a bear trend below them. They'll sell them, either one. That's why I put both up. And when you're in a bull trend, they'll buy pullbacks to those moving averages. So this is on a scale 1 to 10, maybe a 10. But remember, the market is, I think, running on fumes. Maybe we get a blow off top. And highlighting this because that's very possible. And don't overthink it. If you're looking for long trade ideas, you buy Home Depot here. You set a stop somewhat below. Again, somewhat, because sometimes, no, a lot of times, more often than not, the nefarious forces in the market, hedge funds and trading desks and algos, market makers, they know where the stops or they know where support is. So they know people are going to buy it here. So if they can pop it down below there, they get to blow out all those stops. They turn around and buy it, and then they run it up. So you've got to put your stop a little bit out of reach, somewhat below. And so let's just say, we don't even have, we did have, actually, take that back. We had negative divergence at that high. We sure did. Either way, Home Depot probably topped, in my opinion. But again, I'm trying to speak completely unbiased here. Forget about where I think things might go. But I can tell you with a high degree of confidence, this is a very objective entry on Home Depot at triple support, 200s. Price support about 379.87 and that uptrend line, which is well defined. If we reverse here, you're going to have 4 clean reactions. So there's your stop somewhat below. Somewhat is relative to your price target. If you're on board with a lot of these Yahoo Johnny-come-lately analysts that are coming out of the woodwork right now, God forbid they were telling you to buy here. They weren't. Most of them thought the world was going to come to an end. There was a lot more downside because these tariffs were comparable to, Armageddon, financial Armageddon. But they're coming out now and they're calling for, Dow, whatever, crazy numbers and huge upside gains. But look, maybe they're right. Guys, some of them are going to be right. Some are going to be wrong. That's it. So I'm going to leave it there. So your stop, what I was getting at, would be commensurate to how far you think Home Depot might go from here. I was just going through the sector. I had to stop on that one because I noticed its support. But it's also broken down, and what's going on. This is a pretty impulsive sell-off. It looks a lot like when it peaked back here. That's a very almost identical drop. The slope of that line and the magnitude of it, how much it dropped and how fast it dropped. And then it had a little, they bought it. They bought the 200s, guys. They bought the same exact price level, and it did that. Now, the thing is, history doesn't always repeat. It often rhymes, but that's whatever. It's possible, but I don't think we're going to get that out of that. It's certainly possible, and that would be a potential bounce target. And one thing before I leave this stock, I'm going to put a max upside target right here because that's where it did bounce before, and it's also this reaction high right here. That's big resistance. So if you're looking at a game of bounce and you want just a simple, relatively smaller target, you could shoot for that. And that would be, I would sell a little bit below it. It's a very obvious target of almost 13% profit on Home Depot. McDonald's already broken down, top tier on that divergent high. It's not at support yet. Booking.com. And the reason I'm doing this, again, these are the consumer discretionary. It shows you that sector's softening. And in my opinion, increases the odds that a recession's coming, that the consumer is tapped out. And God forbid, they're not spending money with the stock market at all-time highs. And we know the reason. It's been well documented lately. The wealth divide is widening at no other pace in history. The haves, which are an ever-shrinking number, the amount that control the wealth, the amount that own stocks, they're having a great time right now. Their 401ks and Nvidia and all that's doing great. And then you have to remember, the vast majority of Americans have very little, if any, stocks, and they're struggling right now. And so this is starting to reflect in a lot of these charts. Lowe's put in a divergent high right there, just like Home Depot. Lowe's is usually gonna, not always, but usually gonna follow Home Depot. Also, look, also at the 200, right a hair below the 200, 200 simple, 200-day simple moving average. All right, I could do this all day long, and this is what I do. I'm going to stop the video, and I'm going to go through probably every stock in XLY, all the consumer discretionary stocks. I'm going to look at other sectors too. I just wanted to go over that, tell you the things I'm watching, and share a few trade ideas with you. I think I did that TPR. Let me make sure. I can't remember. It was on my notepad. If I didn't, Tapestry Inc. There's your beautiful cleanup trend line. Nice, big bearish rising wedge pattern, complete with the, I won't call it requisite, but what I prefer to see, divergent high. And there's your targets, 101.92, 92.97. You've got the 200-day moving averages coming in a little bit below that. So let's just say right now, let's keep that as a preferred target there, 92.97. 79. So you cover a little bit above that, 92.80. Cover a little bit above that, around maybe 90. I would just above, just under 93 or around 93 you can cover. And that would be, if hit, that's going to be about a 17% drop on that one. All right, I will end it here. I'm going to hunt for more trade ideas, and I had meant to, and I'm going to do it in a separate video, cover the mining stocks and the metals, and I'm even going to include platinum and palladium in there. So that'll be the next video, and I'll get to that soon. This has been Randy Finney with Right Side of the Chart. Have a great day.